So in the last meeting they had, Powell said, we are committed to getting back to 2% inflation. And so, they vowed, they promised, they're committed, all these big fancy words. But I think they're pretty much focused on that number. So in the past, you kind of point back to 2018, we're getting back to the levels where they had to come off of that. So for the listeners, Jay Powell came in, took over the Fed, and was fired up to change the system. And he wanted to get back to normal, and he wanted to raise rates back up again and all these things. He wanted to decrease the balance sheet, all these things. He wanted to fix the system. And very quickly, the markets didn't like that, and they started rolling over very fast. And to the point TXMC is making, they were forced to pivot off of that because the markets were breaking apart. But today, the markets are breaking apart worse than we saw at that dip. But at the same time, they're not ready to pivot. And I think it's because they're focused on a completely different metric, which I want to dig into with you even more. You're listening to the Mark Moss Show. We're talking about the decentralized revolution, talking about Bitcoin, cryptocurrencies. We're talking about the markets, the reason why we need Bitcoin and what drives that. I'm in the studio with TXMC. You can find them on Twitter at TXMC Trades. We're going to be talking about that. I want to talk about, again, like I said, the markets. I want to dig into some unemployment, some other metrics, look at what the Fed's focusing on. We're going to bring it back to Bitcoin and what we think is going to happen with Bitcoin in the near future. The Fed pivot in 2018 and how they're looking at different data. So last time they moved on the markets, and a lot of people this time were thinking that, maybe they'll let the markets drop 20% before they pivot. And now here we are much further, 25, 30%, depending on which index you're looking at. And yet they don't seem to be ready to pivot. And in my opinion, I basically have listened to what they said, and they said they're focused on getting inflation back under control. I spoke at a conference 2 weeks ago, about a week and a half ago, and Joseph Wang was there. He's a former Fed insider and a Fed bond trader, and he said the same thing. He said they're 100% committed to that. He said they need to see meaningful movement off of that. So we're at 8.6. They need to see a 7.6 and a 5.6 before they'll do anything. But a lot of people also think they'll wait until something breaks. What do you think about that?
Right, that's the $1 million question.
That's the $1 million question.
Yeah, what's the thing that's going to break? And I think there's a lot of different forces that are working here, right? You named inflation. That's their clear stated number one priority. It's the number one priority of voters in a midterm election year, angry voters. And inflation affects everyone. It affects more people than falling asset prices do, right? Like the stock market affects a certain percentage of Americans who have a lot of their wealth there, but there's half of America or more that don't have any stock exposure to speak of or anything meaningful. And so they don't really care so much about what the S&P is doing. They care about the prices of gas, the price of shelter, right, the price of meat and eggs. Right. I think what we're likely headed for, it's hard to know what the thing is that will break. Maybe it's the credit markets like you and I were just talking about. We thought it was going to be the bond market, but it seems like they've done most of their sell-off, at least to this point, and maybe they're waiting for some new narrative that drives yields higher. I couldn't fathom yields breaking out of a 40-year trend with record debt, but regardless, it seems bonds have cooled off a little bit. So with all of this talk about unemployment being low, the labor market is strong, that's what they keep saying, I really feel that they're just going to continue tightening until we have some kind of a blowout in the labor markets, and then they're forced to seriously consider helping people through stimulus or reinvigorating the economy, even though inflation is really high. And I think this controlled demolition, which is a term I've heard a lot of people use. Danielle DiMartino Booth has talked about this a lot. I feel like over the last few months, we haven't seen that sharp, volatile fall from a bubble pop like you were describing. And it's been more of like this controlled demolition. Like you said, the Fed hasn't tightened that much. They've talked a lot about tightening. And the market has done 90% of the work for them. And the bond market even got out ahead of the Fed a bit, which is why I think partially it's coming back some. I really believe they're going to continue to tighten. And because of some demographic issues, there's only, I think, so much labor that can really come back. And so they're hoping to see job openings fall, or at least that disparity between the people who want to work and the amount of available work close down, because that's what they're calling demand. And I really think that as long as inflation remains elevated and it continues encouraging them to stay on this path, that they're just going to push until something like that breaks. And if we're about to have a Q2 earnings season, it's anyone's guess how good or bad it is. And if we see some surprises to the downside, if there's serious pain inflicted on consumer spending on the nominal level, because I think most people are looking at nominal numbers going up because prices are going up and they're ignoring the weakness in real numbers. But if we see actual falls in consumer spending, that might start to wake up the Fed, because the economy is powered by the consumer. It's powered by their spending, and that is what powers tax receipts, which currently are not enough to pay the government's obligations. They have to get money from somewhere. So there's a certain point where falling GDP is antithetical to the Fed maintaining good standing on the debt.
Yeah. Yeah, I mean, there's so many levers. It's such an intricate web to sit there to try to unweave, if you would, and it's like the one thing we can see is that if they're committed to bringing inflation down, and they're talking about price inflation, so the price of consumer goods. And so when you talk about gas prices are a big thing. We see the president tweeting about that all the time. He doesn't know what he's talking about,
right?
But he's still tweeting about it. We know it's a hot point, right? So gas prices, food prices. I commented on a tweet from Lynn Alden earlier today talking about how food prices have gone up by 12% in the same time that, what is it here? She said, price of food used at home rose 12% last year, while average wages rose 6%. Mm-hmm. And so, that's a big problem for people to have. And I had said, basically, humans can take a lot of pain and struggle brought on by central planners as we approach peak centralization. But the catalyst that always swings the pendulum back is always food. Because if you can't eat or feed your family, it's time for change. And so we have food and energy, right? Those are kind of the two main things that you need to live. And so people are screaming about that. And so the Fed can't print more food or energy, right? They can't do that. Right. And there was a testimony I talked about, I think, a week or two ago, and it was Senator John Kennedy, and he was questioning Jay Powell. And he said, so, there's two levers, right? Supply and demand, and the Fed can't increase supply, so you're focused on destroying demand. Is that right? And Jay Powell's like, yeah, right. We're focused on destroying demand. They talked about we need to bring stocks down to lower demand, so the wealth effect, right? So if they make people feel poor, their retirements come down, their house come down, et cetera, they just spend less. And so I think the point that you're making, or at least I think, is, and I'm agreeing with, is that looking at the consumer spending is probably a better indicator than the CPI, because the CPI is more of like a lagging indicator. And if they're starting to spend less, then we know the prices might be coming down. Is that kind of what you're seeing?
It is. Their spending and their wages are the things that I watch a lot. And, real wages are quite negative. And real consumer spending is not strong, despite nominal values being elevated because prices have gone up. There's certain things people just have to buy. It doesn't really matter how expensive it is. They can only, choose the cheapest item on the shelf so many times for that basket of eggs that they must have, right?
Yeah. Yeah, man. And so this is a problem in the U.S., but as we talked about, there's a problem globally. And the whole financial system is changing right before our very eyes, which is pretty interesting. We can see emerging markets are dropping like flies, and now there's protests all over the world with we see currencies going down. Now we see countries going basically to a standstill, stopping, and basically a new payment system that the BRICS nations are setting up in real time. So we have all these catalysts, which really signifies the world is kind of changing as we know it.